Are you considering dipping into your retirement account? You're not alone. In fact, a growing number of Americans are reaching into their retirement accounts earlier than they planned. While that may help solve an immediate financial problem, it can create a much bigger challenge down the road. In this video, we're covering types of retirement withdrawals that are allowed, the cost of early withdrawals, and what investors can do before withdrawing. So let's get into it. According to Vanguard, roughly 6% of participants in its retirement plans took hardship withdrawals in 2024. That's up from about 5% the year before. A hardship withdrawal is different from simply cashing out a retirement account. The IRS allows hardship distributions in certain situations involving an immediate and heavy financial burden. Examples may include medical expenses, costs related to preventing eviction or foreclosure, funeral expenses, certain home repair expenses following a casualty loss, and some education related expenses. Now, here's the important thing: just because a hardship withdrawal is allowed doesn't mean it's free from taxes or potential penalties. In general, hardship withdrawals are limited to the amount necessary to address the financial need, and they may be subject to ordinary income taxes. Depending on your age and circumstances, you may also owe an additional 10% early withdrawal penalty. Hardship withdrawals generally can't be repaid to the investment plan or rolled into another retirement account later. Once the money comes out, you may permanently lose the opportunity for that portion of your retirement savings to continue to grow tax advantaged. Many investors are surprised to learn that there are other situations where retirement funds may be accessed before retirement age. In fact, in many cases, the real question isn't whether you can access the money, it's whether taxes and penalties may apply when you do so. For many retirement accounts, withdrawals taken before the age of 59 and a half may be subject to ordinary income taxes and an additional 10% early withdrawal penalty. That's under Section 72T of the Internal Revenue Code. However, the law provides certain exceptions that may allow investors to avoid the penalty in specific situations, subject to applicable rules and limits. Some examples include qualified birth or adoption distributions, some medical expense situations, disability, qualified education expenses, and first-time homebuyer distributions from IRAs. These could potentially not be subject to the 10% early withdrawal penalty. And depending on the type of account, the rules can be very different. For example, Roth IRA contributions can generally be withdrawn from the Roth IRA at any time tax and penalty free, even under the age of 59 and a half. With Roth IRAs, they follow ordering rules in terms of distributions. You start with contributions, then you move into layer number 2, which is amounts that you converted from traditional pre-tax accounts to a Roth IRA, and then you move into earnings. Contributions, as mentioned, can be taken out in many cases tax and penalty free at any time under 59 and a half. Amounts that converted from traditional to Roth, as long as they've seasoned for 5 years, those also can be taken out tax and penalty free prior to 59 and a half. Remember, earnings will need to stay in there until 59 and a half or older. And if taken out prior to 59 and a half, there will most likely be taxes and a 10% early withdrawal penalty. That's why it's important to understand not just whether you can access retirement funds, but what the tax consequences may be before making the decision. Now, before we discuss the cost of early withdrawals, if you find this video helpful, why not give us a like and let us know down in the comments section what you'd like us to discuss on upcoming videos. When people think about early withdrawals, they often focus on the immediate need. What they don't always calculate is the opportunity cost. In other words, the retirement account with tax advantages can grow compounding in the absence of taxation, either tax deferred or, in the case of a Roth, tax free. And that can have a meaningful impact for an individual over long periods of time. Let's say someone withdraws $20,000 from their retirement account. You take that same $20,000, you apply it to a compounding annual return growth rate, and what could that mean over long periods of time? And there's lots of calculators that you can look at online to determine what your specific opportunity cost is. And of course, work with your tax professional and/or financial planner as you navigate this process. Now it's time to get real about this. When hardship withdrawals reach higher levels, it tells us something broader about the economy and household finances. Many Americans are dealing with higher living expenses, rising insurance costs, increased debt burdens, unexpected emergencies, and reduced emergency savings. In many cases, retirement accounts, unfortunately, have become a financial safety net of first resort instead of last resort. Now, that doesn't mean someone should never take a hardship withdrawal. Life happens. It does highlight the importance of planning ahead and building financial flexibility outside of retirement accounts whenever possible. And as mentioned, team up with your tax professional and or financial planner to navigate this process, understand the nuanced rules, and how to make an informed decision. Retirement accounts can be powerful tools for long-term investing, but their greatest benefit often comes from giving investments time to grow in the tax-advantaged account. Before accessing retirement funds early, take the time to understand both the short-term benefit and the long-term costs. Because sometimes the most expensive withdrawal isn't the money you take out today, it's the growth you give up tomorrow. Are you looking to learn more about building retirement strategy designed for long-term growth? Visit trustetc.com or connect with an IRA counselor to learn more. If you liked today's video, don't forget to subscribe and hit the bell icon to get notified every time we post a new video. I'm John Bowens with Equity Trust. Thank you for watching, and we'll see you next time.